Hello students, welcome to our lecture on investing in government securities. We will talk about government bonds and treasury bills in this lecture. The key for building a good portfolio means the investment holdings that will perform well in all economic situations is diversification. Diversification means spreading your money across different type of investment to be safer. It's like not putting all your eggs in one basket. This helps to protect your money if one investment instrument doesn't do well. Government securities are investments backed by the government, making it a safe choice. Adding them to your portfolio can make your portfolio more stable and secure. So let's learn more about government securities and how they can improve your investment plan. In order to finance various activities and projects, the central government issues securities. These securities are essentially financial instruments like bonds and treasury bills. These securities are sold to investors like individual investors and institutions to raise funds and meet different financial needs. One of the primary reasons for issuing government securities is to bridge the financial deficit. When government's expenses exceeds its revenue, it faces a budget deficit. To cover this shortfall and continue funding its operation and public services, the government borrows money by selling securities in the open market. Additionally, government securities play a crucial role in infrastructure building. Developing and maintaining essential infrastructure like roads, bridges, schools, hospitals require significant fund. The government may issue long-term bonds to raise capital for these large-scale projects. In summary, government securities serves a significant source of funding for central government, enabling it to address financial deficits and undertake critical infrastructure projects. For investors, these securities offer a reliable means to invest their money, providing a stable return on their investment while supporting the government in its economic and developmental activities. So it's a win-win situation for you and the government. You get the safest investment option and government gets the money. So how these securities works? When an investor purchases a government security, they will essentially lending money to the government. In return of this loan, government promises to pay back the principal amount at the end of the securities term, means maturity, along with periodic interest payment during the securities duration. So in short, government doesn't pay the entire interest at the maturity, government pays the periodic interest on government securities. Now, some features of the government securities are investing in government securities is often considered a safe option because they are backed by the government's credits and its ability to collect taxes and generate revenue. As a result, they are perceived having a lower risk compared to other forms of debt instrument. Furthermore, government securities are highly liquid. You can easily buy or sell them in the secondary market before their maturity date. So it is not essential that you should wait till the maturity date. If the maturity date is 40 years down the line, then you cannot wait up till the maturity. You can sell them in the secondary market anytime and convert them into cash. This liquidity enhances their attractiveness to the investors seeking flexibility in managing their investment portfolio. The interest is paid half yearly or annually. As government is acknowledging its debt obligation, there is a sovereign guarantee to the interest as well as the principal amount. So they are considered to be the safest option. Now, types of G securities means government securities available in the market are shown on this slide. They are like treasury bills. Treasury bills are short-term government securities with maturity of 91 days, 182 days or 364 days. They are used by government to raise funds for short-term needs. Investors buy T-bills at a discount rate, and on the maturity, full face value will be paid to the investor. The second type is called as dated government securities. Dated G-Secs are long-term debt instruments with maturity ranging from 5 to 40 years. They are used by government to finance long-term projects and infrastructure development. Investor receive regular payments. It is called as coupon rate, coupon payments in the jargon of government security investments. They don't call it as an interest, they call it as a coupon rate, and get back the principal amount at the maturity. The next is cash management bills, shortly called as CMBs. CMBs are short-term government securities issued for cash management purpose to address temporary mismatch in the government's cash flow. They have maturity less than 91 days and help the government in efficient liquidity management. So when there is a short-term fund mismatch, the government uses cash management bills to raise the funds. The next is SDLs, state development loans. SDLs are debt instruments issued by state government to raise funds for various development and activities and expenses. They have different maturities and coupon rates and offer investor a way to support state level initiatives. The next is gold bonds. You might have heard about sovereign gold bonds. Gold bonds are government securities denominated in grams of gold. They allow investor to invest in gold without physically owning the gold. These bonds have fixed tenures and the interest is paid periodically. Each of these government securities serve different purposes and provide investor with various options to suit their investments. Let's see these government securities one by one. We will discuss about T-bills and dated G-Secs and sovereign gold bonds only, because the other G-Secs are not very popular. They are not meant for the retail or novice investors. The most popular GSEC is T-bills. There are different type of treasury bills, each with a specific maturity period. This offers investor a flexibility in choosing the investment horizon that suits their financial needs. The first is 14-day treasury bill, next is 91 days, then next is 182 days and 364 days treasury bills. Investing in treasury bills is considered relatively safe since they are issued by the government itself and backed by the sovereign guarantee. As a result, they are often perceived as low risk investment compared to other type of debt instrument. Additionally, T-bills are highly liquid, which means investor can easily buy and sell them in the secondary market before maturity date. T-bills provide investor with a short-term secure and liquid investment options. Now how T-bill works, let's see. T-bills are offered at lower price than the face value, okay, also known as maturity value. This difference between purchase price and face value is called as discount rate. So T-bills are offered at discount rate and on the maturity you will get the face value. For an example, let's take you buy 91 days T-bill for a face value of 200. It is issued at a discount rate of 2%. So for this T-bill, you would pay 196 to pay the T-bill. That rupees 4 difference between what you paid and the face value, that is 200, represent your interest earnings. When T-bill reaches to its maturity date, means 91 days later, the government will redeem the T-bill for its full face value of 200. The table on the lower right side shows the typical yield to maturity amount for treasury bills of different tenure. Yield to maturity is a concept that you can read more about it on the Google. Note that this rate is the annual rate. Since the rate mentioned over is like 6.72 is annual rate. That is for 91 days. the yield is 6.72 by divided by 4. So I am dividing the year by 90 days, means a quarter, there are 4 quarters. So 6.72 divided by 4, so that is equal to 1.68% of the invested amount return you will get at the maturity. Now this 1.66% is still very high as compared to the 3% or 4% annual interest rate offered by the savings account. So if you have the additional amount in the saving banks like 10 lakhs, 15 lakhs, people put it in the treasury bills and earn more interest than the savings bank or saving account. The next is dated GSEC. Government dated securities, also known as GSECs, are often long-term investment instrument issued by the government. They have explicit maturity dates mentioned on it, meaning that the date when the government will repay the principal amount to the investor is printed on or is mentioned on the security. The maturity period range from 5 years to 40 years. Government securities offer regular interest payment to the investor known as coupon rate or coupon payments, which are paid every 6 months. The coupon rate or interest rate can be either fixed or floating. In fixed rate bonds, the interest rate remains constant throughout the bond terms, while in floating rate bonds, the interest rate adjusts periodically based on the market conditions. So the interest rate will change on the floating rate bonds. Some of the dated G securities are fixed rate bonds, floating rate bonds, zero coupon bond, and capital index bond. So let's discuss these types of G-SECs. Let's understand the main type of dated G-SEC. The first is fixed rate bonds. These bonds have fixed interest rate, meaning the coupon rate remains the same over bond's life. Investor receive regular payment at the fixed rate until maturity. The next is floating rate bond. In contrast to the fixed rate bonds, floating rate bonds have variable coupon rate that changes with prevailing market interest rates, which ensures that investor receives interest payments in line with the current market conditions. The next is zero coupon bond. Zero coupon bond are like treasury bills. They do not pay regular interest. Instead, they are issued at a discount to their face value and mature at the face value like treasury bills. The difference between the offered value and the maturity value is your earning. The next is capital index bond. These bonds protect investor from inflation. The principal amount and interest payments are adjusted according to the changes in inflation rate, ensuring that the real value of investment remains stable over time. The main principle of any investment that it should beat inflation. So this is possible with capital indexed bonds. The next is sovereign gold bonds. This is unique investment instrument issued by the government of India to allow individuals to invest in gold without owing physical gold. These bonds are denominated in grams of gold and represent specific amount of gold that the investor holds on paper. Now, some key features of sovereign gold bonds are safety and backing. These gold bonds are issued by the government, so they carry the sovereign guarantee. The next is fixed tenure. Sovereign gold bonds have a fixed tenure of 8 years. Of course, you can exit uh, after 5 years. Of course, these bonds are also available in the secondary market, but their liquidity is less as compared to the other bonds, means their trading is less as compared to the other government bonds. Interest income, this SGBs, sovereign gold bonds, offer additional benefits of annual interest rate at a fixed rate of 2.5% on the initial investment. The interest is paid semi-annually, that is half yearly, after every 6 months. The next is redemption flexibility. Investor have an option to sell HGBs on stock exchange before maturity, providing liquidity and flexibility to exit the investment. But as I told you that on in the secondary market, the less amount of HGBs are available for trading. The next is its gold price link. The redemption amount at maturity is linked to the prevailing gold price, which ensures that investors receive the current market value of gold for the grams represented by the bonds. So it's like owning a physical gold by avoiding the risk of holding it. So no making charges and purity concern. The gold things are often have purity concern. Nowadays, government has introduced hallmarks, but still there is a purity concern in the mind of Indian people when they purchase gold. So generally, Indian people don't change their goldsmiths over the generations. So HGBs eliminate the issue of making charges and concerned about purity of gold. If you convert your gold into jewelry, there is a tremendous amount of making charges you have to pay. So in conclusion, sovereign gold bonds provide an avenue for investors to participate in gold market and diversify their investment portfolio. They offer the benefits of safety, regular interest income, and potential capital appreciation. This makes it an attractive investment option for those looking to invest in gold while avoiding the drawbacks of physical ownership of gold. Let's discuss about government securities in secondary market. Government securities are actively traded in secondary market, which includes major stock exchanges like NSE and BSE. GSEC are actively traded in secondary market and their prices are influenced by prevailing interest rate, maturity dates and the inflation rate. So three factors plays key important role while deciding the price of government security in the secondary market. The first is interest rate, that is the coupon rate, maturity date and the inflation rate. As interest rate rise, bond prices fall, and when interest rate decrease, the bond prices tends to rise. This dynamic relationship make the secondary market a platform for investor to buy and sell bonds based on changing market condition and their investment objectives. Now, how to buy government securities? RBI has opened this sector to retail investor recently. The government securities sector was available only to the institutional investors, means mutual fund house earlier. Now RBI is encouraging retail investor to buy T-bills and government bonds. For investing in government securities, you can open an account at rbiretaildirect.org.in, which is the site for opening an account for retail investors. The account opening is very simple process. Once you open the account, you can buy securities from RBI. It is allotted to you on the very next day in your demat account. You can trade them once they are allotted. You can trade them in the secondary market. So there is an auction of these government securities in on a specific day that will be mentioned on this site. You can try and you can buy the government securities. They will be allotted to you on the very next day in your demat account. Otherwise, this is the primary market condition. Otherwise, you can go to the secondary market and buy government securities very easily. So here is a final word from my side about investment in government securities. Government securities are considered risk-free investment because they are backed by the sovereign guarantee. Their assurance of repayment makes them one of the safest investment options available in the financial market. Another advantage of government securities is their high liquidity. They can be easily bought or sold in the secondary market, allowing investors to convert them into cash whenever needed without significant price fluctuations. Government securities offer periodic interest payments. These interest payments are known as coupon payments. This payment provide investor with a regular income stream, making them good option who for the investor who seek the periodic stable returns. However, investing in government securities does require some understanding of the economy and financial markets. Being aware of economic trends in interest rate movements and inflation can help investor make informed decisions to achieve better returns. So if you want to invest in long-term government securities like government bonds of maturity more than 10 years, you need to know about economic trends, how the interest movement will take place in next 10 years and how the inflation will change in next 10 years. So if you have this knowledge, then you can get better returns from long-term government securities. So for novice investor, for beginners, starting with T-bills or investing in debt mutual funds can be suitable approach. T-bills are short-term government securities with low risk and high liquidity. It makes it a beginner-friendly investment option. On the other hand, debt mutual fund pull money from multiple investors to invest in various fixed income instruments or long-term government securities, offering diversification and professional management. So the beginner should either buy the T-bills or invest in government securities through debt mutual fund. Debt mutual fund are the kind of mutual fund who take the money from people and make investment in government securities, and the returns are provided to the retail investors. So debt mutual fund is the best option to invest in long-term government securities. In one of our upcoming lectures, we will discuss about debt mutual fund. Now, sovereign gold bonds are an attractive option for those interested in investing in gold. These bonds are issued by the government and are denominated in grams of gold. So you get 1 gram, 2 gram, 5 gram, 10 gram, 1 kg gold bonds. HGB offer the benefits of earning regular interest income and capital appreciation based on changes in the gold price. Additionally, they provide safer alternative to holding physical gold as they eliminate concern related to purity and storage. The bonds are issued in paper format, so there is no issue, and they are stored in the demat account. So there is no concern about purity or storage. So this is all about government securities investment. See you in the next lecture. Thank you for your attention. Thank you.